Welcome to the Deep Dive. Today, we're doing a quick, sharp analysis of the market for January 12th, 2026.
And the big story is a market that seems to be pulling itself in two completely opposite directions.
Exactly. It's a real split. You have capital just flooding into high-growth AI stocks.
But at the same time, money is sprinting towards safe havens. I mean, gold just hit an all-time high.
So it's risk on and risk off happening simultaneously. Let's start with the macro pressures, because that's what's driving this.
It all comes down to interest rates. The U.S. 10-year Treasury yield is hovering around 4.17 to 4.19%.
And that's still high enough to put a real squeeze on those high-growth tech valuations.
A huge squeeze. It just mathematically drags down the present value of their future earnings.
Okay, so that's the headwind. Now, what about the Fed? The market seems, well, completely divided on when they'll actually cut rates.
Absolutely. Everyone's waiting for the next big data point. The last jobs report show things are slowing down, but not falling apart.
And inflation.
It's come down, but it's sticky. So the Fed is basically in a holding pattern until the next CPI or PCE report gives them a clearer signal.
This tension is showing up in asset flows, right? You said capital is bifurcated.
It really is. On one side, you've got the AI and tech story. On the other, a rush into gold and silver.
And because trading volumes are low, any piece of news can cause these huge, sharp moves.
Right. It exaggerates the volatility. Speaking of which, the VIX, the so-called fear index, is sitting at about 15.
Which sounds low, but it feels like a thin layer of ice.
It is. It suggests the market isn't panicking right now, but is very vulnerable to a shock.
And we just saw what a shock does. It sent gold to a new record.
A historic record. Spot gold hit an intraday high of $4,563.61 an ounce.
So what's driving that? Is it just the rate cut expectations?
That's part of it for sure, but it's also geopolitical tension. And there was that report about an investigation involving Fed Chair Powell.
Ah, right. That hit the dollar and sent people running for cover.
Exactly. The dollar index, the DXY, dipped to around 98.9, and that just added fuel to the fire for gold.
Okay, let's pivot to the core assets. How are the big index ETFs like VOO holding up?
VOO, the S&P 500, is basically consolidating. It's just moving sideways at a high level. That's your core defensive position.
And QQQM for the NASDAQ.
That's all about the AI news flow. It's completely tied to the sentiment around the big tech names, NVDA, GOG, and so on.
Now for the high-risk side. Bitcoin. It's holding at a very high level.
It is. We're seeing it oscillate in, the $91,000 to $92,000 range.
What's driving it now? Is it still retail?
Not so much. It's really about institutional flows now, especially from the new ETFs. The market needs that big money to keep coming in to justify this price.
And what about Ethereum?
ETH is tracking around $3,100, basically mirroring Bitcoin. Then you have your higher beta plays like SOL and BNB, which are moving even more dramatically.
Okay, let's tie this all together. We have high rates, record fear in gold, and explosive growth in AI. What's the strategy?
The strategy has to be defense first. That means using VOO and QQQM as your core holdings.
And for the big AI names, you can't just chase them at these levels.
No, you use a phased entry, you buy the dips, and you absolutely have to use options or keep a cash buffer for protection.
What about hedging with gold now that it's at an all-time high?
You almost have to. A small allocation to a gold ETF or even physical metal is just smart insurance against systemic risk right now.
And for crypto, for someone looking to get in at these levels.
If you're trading short-term, your positions in BTC and ETH need to be small, phase, and have strict stop losses. For long-term holders, just continue to dollar cost average.
So the final thought is that the market is pricing in two extreme and opposite outcomes at the same time.
Yes, and the critical question for you to consider is this. When the next big economic reports land CPI, jobs, which story is the market going to believe?
Is it the risk story that favors gold or the growth story that favors AI?
Exactly. That's the pivot you need to be watching for.